Well, thank you, Kendra. And I hate that we have to do this over Zoom, but hopefully it does reach a as broad of audience as possible. Um, like Kendra said, my name is Nicholas Brown. I'm a professor at NC State within CALS, the Agricultural and Resource Economics Department within CALS. I am about as new as it gets for a professor at NC State. I started in August, on August 16th, and now it's February 20th. And initially, when I was pitched the job, and it was a dream job to be able to work as an ag lawyer, and to do tax things, which is the main thing they brought me in for. And they pitched the job to me, and they were like, "We're going to give you plenty of time to work out, um, to get a strong emphasis in tax." I had some background in it. But they were like, "You're gonna have plenty of time to slow roll into this." I started in August, and then in September, Helene hits. And so I've been doing my best. I haven't been pressured from the department, but I've been doing my best to get a background in storm tax relief, especially for farmers. And that is a very specialized form of tax knowledge. But the one thing that I like to start out every presentation with, especially at the beginning of my career, is the disclaimer that tax law is very complex. It's going to hinge on details that only somebody who would have access to your books or your QuickBooks or your whatever software you use to keep records. And tax law often changes, as well as your personal situation often changes. And where those situations, at least in the federal laws, may be changing in the near future, I'll let you know. But for the most part, I just want y'all to know that this is like a general overview of tax laws that you may want to take advantage of. So this presentation and any questions and answering that I provide in this, it's not formal legal or tax advice, but hopefully it can be helpful so that you can take this to your tax professional, your CPA, or your enrolled agent, and hopefully be able to take advantage of. I'm just trying to give people the best platform of knowledge that they can base decisions off of from now until tax time, because there's some pretty big deadlines coming up that have been made pertinent, not just due to Helene coming through and making your financial situation potentially tighter, but also with some of the extensions the IRS has done. Um, One other note, I start with the disclaimers, but I always like to tell folks, just because I'm limiting myself at the beginning, you know, asking me any questions you have. I'm here to help. And if I can't answer your question, I'll tell you. I don't want to lie to you. I don't want to give you, misconstrue any information that I may be acting on. But shoot me an email. My email is at the bottom of this, or sort of the middle of this slide. I also run a website along with the other law professor in our department, Andrew Brandon. The link to that is there. These slides will be posted along with this entire presentation, and the information within it on an article that I'm going to post next Monday. My email and my website will also be at the end of this. And so if you think I don't have a question now, but you do it as we go into this, you'll have another chance to write this down. And again, there will be an article that gets posted about this information so that hopefully it can help as many people as we can, because we monitor the metrics on each article that comes up, and we've been getting a lot of hits on the Hurricane Helene stuff, and understandably so. I like to start out every presentation with what I call a roadmap. Some of y'all probably came into this presentation hoping to have very specialized questions answered, and hopefully those questions do get answered in this. But at the same time, I don't want you to miss anything while you're waiting on that answer, because I know what it feels like to sit through something and think, I hope this is going to come up at some point. But if not, shoot me an email. If it's not on this list, shoot me an email, and I'll still try to find a way to answer it. And so Kendra, along with the other folks that I've done this presentation for, the other extension agents, have done a really good job of collecting questions from the community. And this list sort of represents the types of questions that have been asked. Some of it is not related to storm relief at all, directly, but it correlates with some of the decisions you have to make. And some of it is directly related to storm decision or post-storm decisions that you've been having to make. And so we'll talk about accrual versus cash basis. Spoiler alert, most of y'all probably are cash basis. We'll talk about the extensions of tax deadlines that both North Carolina and the IRS have made, so both federal and state. And we'll even talk about things as local as your property taxes. And then we'll get to the meat and potatoes of storm relief, which is the disaster relief payments, whether that be the FEMA money that you may or may not have gotten, or if you even got money from a GoFundMe, because that's come up a fair amount of times in my presentations. We'll also talk about insurance proceeds and sales of livestock due to weather, as well as casualty losses, and we'll talk about what those means as we go through it. And at the very end, I said that I was new, but there's a group of ag tax professors across the nation, and they put up resources exactly for folks in y'all's situation. And I'll share those resources at the end. So if you think, well, he didn't answer my questions, well, maybe these folks will have something that answers your question. And so to start it off, we'll talk about accrual basis versus cash basis. This is just the accounting method that you use. And so cash basis is, by definition, it's when transactions are recorded when cash is paid or received. It's used almost universally by small businesses and farms. I think about 98% of farms are cash basis. And the reason that is one, because it's the IRS default, and two, because it's just easier. Accrual basis is really useful for companies, that have the ability to have like a whole dedicated accounting department. But if you don't have that sort of resource and you don't have the ability to have that kind of overhead, then cash basis is what most people go with. And accrual basis, on the other hand, is just when you recognize revenue or expenses recognize revenue when it's earned and expenses when they're incurred. I realize it's a little like the terms don't really make a lot of sense, and so I always just give this example. And so the example that I give is two farmers. One of them is cash basis, one of them is accrual basis. They each purchased 10 years worth of fertilizer in 2020. The cash basis farmer recognizes all 10 years of that expense in 2020. So if he's spent $10,000 worth of fertilizer in 2020, it doesn't matter that he only used 1 year of that fertilizer in 2020. He recognized $10,000 worth of expense in 2020. Whereas the accrual basis farmer, he expenses 10% or $1,000 of that purchase in 2020, another 10% in 2021, and so forth until he just runs out of the fertilizer. And you can imagine if you did that for every single expense and every single revenue that you had, it would get, hard to track certain things. And so that's why most folks use cash basis. This is important because you have to be a cash basis filer with the IRS for certain of these rules to apply. And I think I get this question a lot because people see that you have to be a cash basis filer. And they see that and they're like, well, I don't know what kind of filing that I am. And if you don't know what kind of filer that you are, you're almost certainly a cash basis filer. That's not a universal rule. It just is, it's broadly applicable based on the numbers of who files under what type of system. So in terms of the extension of federal tax deadlines, Helene struck in late September. There were some deadlines that had occurred right before September, dealing with various things that I won't get into. Those didn't get moved, but anything past Hurricane Helene getting struck, the IRS said that these deadlines are going to get moved. And so the next big day for the IRS deadlines was October 15th, 2024. So about 2 weeks after, or 2 or 3-ish weeks after Helene hits, the IRS steps in and says all these deadlines from October 15th, 2024 through May 1st, 2025 are getting moved to May 1st, 2025. Now, if you paid your 2023 taxes on time, back in April, then you won't have any issues with your 2023 taxes at least. But it's not unusual for your 2023 tax returns if you receive an extension, usually it gets pushed to October 15th of 2024. And if you had been waiting on that deadline, and you hadn't filed yet, well, May 1st, 2025 is now your deadline for your 2023 taxes. Additionally, if you had any payments that were due from October 15th to May 1st, and some of your big deadlines there are January 15th of this year and April 30th of this year, those are also pushed back to May 1st. And so a lot of folks, when they saw the IRS extensions, they only thought about their 24 taxes, but 23 taxes were also pushed back. Now, the IRS, when they did this, realized, well, we can't push our 2023 taxes back further and make them due after the 24 taxes. And so the 24 taxes are also due on May 1st, 2025. So you got about a 2-week extension out of it. And that's just to avoid the logical inconsistency of having your 23 taxes due or due after your 24 taxes. Now, the kicker to that is, and this is something you should be concerned about if you hadn't paid your 23 taxes yet, or if you hadn't filed your 23 taxes yet, you have 2 years worth of tax returns due on the same day. if you had not if you had filed for an extension in 20 for your 23 taxes. And so that can result in a pretty significant tax bill on May 1st, 2025, if you had not paid your 23 taxes on time. It's one of those situations where you would have paid both regardless. But just speaking from a personal finance perspective, it's hard to have an expense of that magnitude hit sometimes, and it's something you definitely have to keep your eye on. That's one thing where you may need to start budgeting now for it. Um, because May 1st, 2025 could end up being a pretty big day on your books. On the one hand, it's really nice that the IRS extended these days out, but by putting both due on the same day, um, that is something to definitely be budgeting for in the future, in the near future at that too, because that's, about 2.5 months away at this point. Now, those deadlines were just the federal tax deadlines. North Carolina, with their state tax deadlines, didn't move them back per se. So April 15th is still the North Carolina deadline for your state taxes, but North Carolina did recognize that they're not going to put a penalty on you if you file before May 1st. And so it's one of those situations where you can file between now and April 15th, and you won't be officially late. You also won't be penalized. But if you file between April 16th and May 1st, you'll be officially late, but you won't have a penalty. Now, if you file after May 1st, setting aside any issues that you have with your federal taxes, um, you won't have any deadline. You'll still be penalized after that point. Now, we'll talk about property taxes on the next slide. And there's not a lot that can be done about property taxes for 2024, but I did want to at least talk about them. But I wanted to give some hope to this because I realized that, a lot of y'all have probably lost a good bit in the last few months, and I want to at least give some good news. And so North Carolina has lowered the state income tax rate for 2025 and 2026. It was too late to do it for 2024, and that was at 4.5%. But in 25, it's going to be 4.25%, and they lowered another approximately 0.25% in 2026 to 3.99%. And so I realize in the coming weeks and months that it may be a pretty expensive tax burden that many of you have to pay. And that's in addition to the things that you might have lost as a result of Hurricane Helene. But at least there's some taxes that look like they're going to be going down in the coming years. Was trying to focus on the positive that we have. Property taxes are something that there's a lot of articles about, especially right now. There's a lot of social media outrage about property taxes. And, I fully support everyone's freedom of speech, but I do want to clarify who you should be directing that speech at. And so before we can talk about what's going on with property taxes, it's important to just talk about how they work. And so property taxes are assessed at the beginning of the calendar year and due around the end of the calendar year. So your 2024 property taxes, they were assessed, meaning that the amount of taxes that you were going to have to pay relating to your property taxes was calculated on January 1st, 2024. Whatever you had on your property then was what you were going to be taxed on. Now, those property taxes weren't due for another 12-ish months on January 6, 2025. And so the outrage comes in with this, from January 1st to September 1st, 2024, most of you did not have any significant changes in the valuation of your property. But once Hurricane Helene hits, if you lost a home or a significant value in your property, you're still responsible for the valuation of your property that was made on January 1st of 24, well before Hurricane Helene hit. And so that strikes a lot of people as being unfair because they say, I'm paying taxes on something that no longer exists. The value's gone down significantly because there was a landslide on my property and the property values have went down substantially. And this is not a county issue, it's more of a state issue. And so county governments are under a mandate from state law to make periodic assessments and reappraisals of a property's value. And so the assessments occur every 4 years, or what I should have put there was the appraisals occur every 4 years, sometimes more frequently. Most of the western counties do it every 4 years, but the assessments occur every year. Um, and so people were, understandably upset about that. And so people have been asking, well, is there anything the local government can do to delay this? And so first question they have is, can the local government extend the delinquency date for property taxes to prevent interest accrual? If you hadn't paid your property taxes by January 6th of this year, so about a month and a half ago now, is there anything that they can be like, hey, we're not going to charge you penalties as a result of this? And the answer to that is no. And that's not because of anything that the counties have done, but under state law, the counties cannot allow that. And so some other folks wanted to get more creative with it. And again, I can empathize with why. And they asked, can a local government change its property tax rate after the year is over? Because they had to have seen this coming, and they say, well, we can't change the property tax deadline day, or payment date, but maybe we can change the rate. And there's ways under the state law that can happen, but it would have had to have happened before the end of 2024. So the moment that the clock rolled over on the new year and it's January 1, 2025, it's too late for the county to do that. And even if they had waited, they would have had to have had certain rules that would have triggered if revenue would have been substantially more or less than was anticipated based on those January 1, 2024 assessment values. And it's, that would have been a hard thing to have met. And so the next question that people come up with is, can a county postpone a reappraisal, the thing that happens every 4 years, generally speaking, every 4 years, uh, that was scheduled to happen on 2025? And the answer to that is yes, if a county makes a decision before January 1st, 2025, and it's not at the end of a maximum 8-year reappraisal period, which is mandated under North Carolina state law. And um, we've had one county that did that, which was Haywood County. And this is, I don't have a line in the slides to talk about it, but generally speaking, for the folks who have lost something, and you want your property taxes to reflect that, you want your assessment to show it, but you don't want a reappraisal to happen, because a reappraisal is going to reflect how much property values in North Carolina as a whole have increased since the last reappraisal was done. And so if a reappraisal gets done, your tax burden on the property tax level is going to increase. But if an assessment gets done, that's only for your individual property value, it'll decrease it. And so an assessment, your 2025 taxes should be lower than your 2024 taxes if you've lost something. And so we've got two special programs that I've seen other counties doing. Burke County is doing a 1-year assessed property value specifically for your 2025 property taxes. So if you lost a significant amount of your property value, Burke County, for at least your 25 property taxes, is going to show you a lower property tax bill. Again, there's not much they can do about your 24 property taxes, but your 25 property taxes, they still have a lot of leeway on, just based on the nature of the timing that's set forth in the state law. Now, Haywood County, had Helene not come through, would have had a 2025 reappraisal that was going to be done. They had already spent a considerable amount of money trying to get that done because, they couldn't have anticipated Helene happening. And Haywood County pushed that back to 2027. And they did that so that your property taxes wouldn't increase significantly. And so it's just the difference between an assessment is good for 25, a reappraisal would probably increase your property taxes, even though your individual property tax went down. It's just the nature of land in North Carolina has gotten more valuable, and that's what a reappraisal would show. And so going back to your 24 property taxes, if you haven't paid them yet, if you think you're going to have trouble paying them, go to your local property tax office and ask them if there's a payment plan they can set up. And also ask them to do an assessment on your property so that you can show the damage that was done so that you can lower the valuation for your 25 taxes. This is one of those situations where under state law, you just have to be acting really early. I know there's a lot of things going on, and this is probably not something you want to think about right now, but, because you've got more important bills, things that you're having to handle, but this is going to be one way to save money in the near future because, 25 property taxes will be due in, about 10-ish months. One of the questions that I got and asked that go along with this is they're afraid their property taxes, their local, any local taxes you get charged are going to go up for this. I am not an economist. I do have a master's in economics in agriculture and applied economics, but I don't have the PhD in it. But what I did to try to help answer this question was I went and found the state report on the projected effect of Hurricane Helene. And they were projecting at the time that state taxes and fee revenue loss was going to be about 135 million, and that your local tax and fee revenue loss was going to be about 293 million. And so this is, Hurricane Helene, obviously immense amount of destruction, but it also came around the same time that a lot of the agritourism activities occur. And so there's a good chance, just based on this data at least, that there's going to be a gap in the tax revenues that have been occurring, and we don't know how yet the government plans on recouping that loss, or how they plan on managing things in the future. But I know that can be worrying, especially, we just got done talking about your property taxes. But when somebody asked me this question, this is the data that I found. The most common question that I've gotten asked is the disaster relief payments that y'all got, or may have gotten at least. And people got those and they were worried, you got them immediately after the storm and you were like, well, am I going to have to pay taxes on this? Because the storm came, close to the end of the year. And you're like, well, is this going to be income I have to pay taxes on? And the answer to that, generally speaking, is no. The IRS states that a taxpayer can exclude what we define as a qualified disaster relief payment from their income calculation. Now, I've got that slide on the next page, but generally speaking, a FEMA payment is going to be a qualified disaster relief payment. This also applies to in a similar sense, if you received money from a GoFundMe, unless you offered that, unless you said, hey, I'll do work for somebody if they donate to this GoFundMe money will also not be considered taxable income. And so those are the two questions that I've gotten a lot with respect to money that came to you, based on these sort of untraditional storm-related means. And so the IRS defines what a qualified disaster relief payment is. I don't want to spend a ton of time on this. Generally speaking, you just have to meet a couple of these prongs. And so if it's reimbursing personal, family, living, or funeral expenses that result from a qualified disaster, which Helene was, and if it's reimbursing or paying reasonable and necessary expenses incurred from the rehab or repair of your home or something that was in your home because of Helene, it's not going to be considered it will be considered a qualified disaster relief payment. And generally speaking, that fourth prong, talking about if it came from a federal, state, or local government agency in connection with a qualified disaster, it's not going to be taxable. Now, the GoFundMe doesn't necessarily, if you received money from a GoFundMe or another charity, generally speaking, that won't be taxable either. I don't have a slide on this because that will be construed as a gift. And as long as you didn't say, hey, if this charity does work for me, I'll, sell them beef, or I will provide them Christmas trees for the next 10 years. As long as you didn't offer to do services or provide goods in exchange, the GoFundMe money will be seen as a gift and you won't be taxed on that. And so that question's come up a pretty good bit. In terms of insurance proceeds, this is when it becomes important to know what your basis was in certain items. And so we'll talk about what that means in a second. Just know that you can deduct losses to your home, household items, and vehicles if it was caused by a federal declared disaster, which Helene obviously was. But you cannot deduct losses that were fully reimbursed by insurance or other means of reimbursement. And so the way this works is, let's say you had a 10-acre plot and it was, appraised at $500,000, and that 10-acre plot had a house on it, and you lost the house as a result, and and now the property is only worth $100,000 because it's now just the land. Um, if you had insurance that paid you $400,000, would fully reimburse the loss, so you won't be able to deduct any of that loss. Um, but if you had insurance and it only paid you $100,000, and so you went from a $500,000 property down to a $100,000 property, insurance only pays you $100,000. Well, now you're only at $200,000, and so you're still down by $300,000, and you could deduct a $300,000 loss. And so it's important to know, where you were at in terms of the basis of your home and how much it was declared as worth. Um, there's a lot of colleagues that we have at NC State and that we have across the country that talk about how to recover the records that would have indicated what that value was. Um, Generally speaking, it helps to have pictures of everything you would have had. So, not that you would have been inclined to delete pictures from before the storm, but those pictures could be really helpful in determining what the value of the home was. Um, Now, if you do find yourself in a situation, and I know it's hard to fight with insurance companies at times, let's say that you had all the losses and the insurance didn't pay you until next year in 2026. If you had deducted the $400,000 loss on your home in 24 and you got paid $400,000 from the insurance company in 26, well, then you're going to have to go back and amend your tax returns. And that income from the insurance company is going to be treated as ordinary income. Ordinary income can be taxed at anywhere from 10 to 37%. And so that's definitely something to keep an eye on and to be talking about with your CPA, especially if you're going through negotiations with the insurance company still. Because as a cash basis filer, if you got the money, even in 25, and you're trying to deduct a loss in 24, it's something to be aware of. Um, and so definitely keep that in mind as you go through any issues with insurance. Although, and I want to sympathize as much as I can. I know insurance might not be an option for a lot of y'all. Just for those of you where it is an option, I don't want you to make the mistake and get insurance money that's treated as ordinary income. In terms of crop insurance, um, if you meet the following requirements, you can postpone the reporting of some or possibly all of crop insurance proceeds as income until the year following the damage. And the reason why you would want to do that is if you received money, I know it's a pretty short, it would have been a quick turnaround, but if you received money, say like December 20th of 2024, you would get taxed on that normally in for the 2024 taxes, which are due in just a few months or a couple months. Um, but if you meet these rules, you could say that, and you received money in 24 from crop insurance, you could claim that as 2025 income instead and delay your the tax burden on it until April 15th of 2026. Um, and so if you are a cash method accounting user, which most of you probably are, I would be surprised if any of you weren't. And if you received the crop insurance proceeds in the year of the damage, aka 2024. Um, and this is the only part that's actually hard to meet this rule for, is if can you show that under normal business practice that you would have included more than 50% of that income from the damaged crops in any tax year following the year the damage occurred, basically showing that you would have made some money from that would have equated to that crop insurance amount in the following years. You didn't receive more crop insurance than you otherwise would have gotten. And so this is one of those rules, I've been adding different rules onto this as quickly as I can. And I'll send these slides out at the end of the presentation. There's a link to this, to the Ag Tax Professor group that we run a website. And they have examples of how this rule works. And so you can click this link and it'll take you and show you different examples. Moving into if you have livestock, I've got two rules we're going to talk about with livestock. And after this, we'll talk about Christmas trees. But IRC section 451G and 1033E are the two rules that you have to make a choice or an election between. We'll talk about 451G first. It works very similar to the crop insurance rule that we just talked about. And so essentially, the way 451G works is if you had a weather-related condition, which obviously y'all went through, and it caused the sale of more animals than normal, aka, you know, storm Helene comes through, it knocks down a fence, there's a landslide on part of your property, you have to sell some cattle because, you don't have the land to hold them anymore. Um, and so 451G and the next rule that we'll talk about is meant for that sort of situation where you sold more animals than you were expecting. Um, and it applies to any livestock that is sold. 1033E in the next couple of slides does not. But if you meet the requirements for 451G, which are on the next slide, you'll be able to defer the income to the next tax year. In other words, you'll be able to avoid the excess income being recognized in 2024. You'll be able to recognize it in 25 and pay it off on April 15th, 2026. I know that's a little tough to follow, but we'll walk through this in a little bit more detail on this requirement slide. And so to get a 451G deferral, your principal business has to be farming, meaning that more than half of your income has to come from farming. If you have a regular 9 to 5 job and you're making 50,000 a year on that job, but you are making 25,000 a year from farming, you won't be eligible for 451G. But if you're making more money from farming than from your principal, than from your any other jobs you have, or if you're making all your money from farming, you don't have to worry about this particular requirement because you satisfy it. Again, you have to be a cash accounting method. Most of you probably are. You also have to show, and this is a rule that trips, or this is the aspect that trips up a lot of people, that the animals that you sold as a result of Helene would have been sold in the following year. And what I mean when I say that, and we'll go back to the previous slide, is they're going to average the amount of cattle or the amount of animals that you sold in the last 3 years. And that's how they'll set their baseline for you. When I say they, being the IRS. And so say in 2021, you sold 24 cattle, and in 2022, you sold 26 cattle, and in 2023, you sold 25 cattle. That's an average of 25 cattle or 25 head of cattle being sold a year. If you sold 40 in 2024, then that's an excess of 15. And so all the income you had from that excess, that 15 head of cattle being sold, you would be able to defer that to 2025. And the reason the IRS allows you to take a rule like this is because they recognize, they've got a lot of expenses. There's been a lot of heartache in the past few months of the previous year for you. And they don't want you to get a bigger tax bill that you only incurred just because you had to sell more livestock than normal because of the disaster that struck. And so it's a very useful rule in that sense. And hopefully it can be useful for y'all. The last requirement is just that the weather condition that caused the area to be under federal disaster caused the sale of livestock. That, if you took that to the nth degree, that might look like it's very strict. The IRS does not regulate that rule very heavily. Hurricane Helene was a national level event. Everybody's going to know if you sold livestock around that period. It was probably, at least in part, due to Hurricane Helene. So don't worry about meeting that particular requirement. One last note on 451G. I don't think this is going to apply to a lot of y'all, but the sale can take place before or after the area is declared eligible for disaster relief. And so if somehow, I don't even know at what point the disaster declaration was made, if it was before or after the landfall of Helene itself. But if you saw in the tea leaves that the storm was coming and going to strike as bad as it was, and you sold cattle beforehand, that doesn't exclude you from being able to use this rule. Again, based on everything that I've read, most folks did not think Helene was going to be as bad as it was in Western North Carolina, just because of how unprecedented it was. But if you did, don't think that excludes you from this rule, because it doesn't. So the other hand, or the other rule, is IRC 1033E. And if you're familiar with 1031 transactions, that's how I sort of liken this. With a 1031 transaction, it's with real estate, and you take the basis from your previous real estate that you're selling and you put it in your new real estate. This works very similar except with livestock, specifically and only draft, breeding, or dairy livestock that you purchase. I know it says within a 2-year replacement period, but if you go 2 lines down, you can extend it to 4 years because it's in a federally declared disaster relief area. Um, and so what this rule is trying to do is postpone the gains realized from the sale when you're using the proceeds from the sale to purchase replacement livestock. And so those replacement livestock that you purchase, so say the storm hits, you sell a bunch of livestock more than you were expecting to, and you at some point you have to replace them over the next 4 years because you're still continuing the farm. 1033E allows those replacement livestock to take on the basis of the sold livestock, meaning you get better capital gains treatment. When you try to take advantage of 1033E, you have to attach a statement on the tax return. You just have to show that there was evidence of the weather-related condition. That can be through pictures. I wouldn't stress too much over this. Again, Hurricane Helene was not something that people don't know about. You also have to show the amount of gain that you realized on the cattle or on the livestock that you sold. And you also have to show the number and kind of livestock sold because, again, they have to be draft, breeding, or dairy livestock. And you have to show the number and kind of livestock that would have been sold under normal business conditions. Again, this is one of the situations where it really helps to talk out certain situations with the CPA so that you can make sure you're meeting these requirements. A couple notes on 1033E. There's no requirement that the weather-related condition causes the area to be a federally declared disaster area. Don't sweat that requirement. That really doesn't apply in y'all's situation. The important part, though, because it's going to take, in certain situations, a while to do the repairs necessary to rehouse the extra livestock, you can purchase these replacement animals at any point during the replacement period. And so you have 4 years to do it. You don't have to worry about doing it this year or next. You've got time. You've got time to rebuild barns, to put fences back in, to repair the land as much as you need to. Smart financial planning can be done with this particular rule. You don't have to be in a rush. And the other thing, and this is one aspect of the rule that makes a lot of sense, especially with inflation as bad as it's been, you have to buy the same value of animals, but not necessarily the same number of animals. Meaning, and I may fudge what the fair market value of certain livestock species are, so please forgive me for this if I'm way off. But let's say that you sold 4 dairy cattle more than normal for $20,000 in 2024 as a result of Helene. Well, that was the market price then, but in 2027, you can only buy 2 dairy cattle for $20,000. You wouldn't want to double that and spend $40,000. Instead, you can still just buy the $20,000 worth and be fine. Now, if you buy less, this is where things get pretty dicey. Meaning buying less than the value that you sold, you're gonna have to amend your 24 tax return and pay additional taxes plus interest. And so that's definitely something to avoid. Now, if you buy more, you have to take the excess amount and depreciate that on future tax returns. That is less work, but still something hopefully that you can do in a separate transaction. And so again, you have an election between 451G and 1033E. A couple factors to consider when you're doing this. The first, and one that probably makes the decision for a lot of you, is 1033E can only be used for draft, breeding, or dairy animals. If you don't meet that, then you have to use 451G if you meet all the other requirements. You can make a switch from 451G to 1033E if for whatever reason, you're talking with your CPA or your tax professional and they tell you, we started out with this, but now we should move from 451 to 1033. You can do that. You can't do the reverse. So you can't go from 1033E to 451G without IRS approval, at least. And it's their discretion if they're going to allow that or not. And I haven't ever seen that being done. And so I don't know what their internal rules are about approving that. And so just know, 1033E is only for draft, breeding, and dairy animals. Um, and so that's usually the one that sets the decision for most folks. And so now we're moving to casualty loss. And this is where the Christmas tree farmers can start to pay attention to certain things. There's three requirements under the IRS rules for a casualty loss to occur. If you lost trees due to Helene, you're going to meet these requirements. It has to be a sudden loss, meaning not gradual or progressive. Obviously, Helene was. It has to be an unexpected loss. Helene was a once in a generation storm. It was unexpected. And for the same reason, it's unusual. Um, Now, the real distinction gets made between business or investment losses and personal use losses. Um, Now, with business, to make the distinction between these two, it's a business or investment loss if you had an expectation of profit. And the IRS will, sort of drill you on this if you don't know. If you try to, get cute with the rules. It's personal use if you only intended it for personal use, if it's for aesthetic purposes, if it was, a hunting property, and you said, well, I could one day maybe sell these trees on this property, the IRS is going to drill you down if you try to, play it smart with those rules. And if you had a hunting property, and you said, well, I could cut down, or sometimes I cut down some of the trees from my own firewood without, that's not really an expectation of profit either. Um, and so there is still the potential, if it was a personal use asset and you had a casualty loss as a result. Um, but there's a lot of restrictions on it. And generally speaking, the juice isn't worth the squeeze, and most people don't try to take this deduction. Couple rules on it. The only personal use assets that apply here, if it's a home, a household item, or a personal vehicle. If it's anything outside of those, it's not a personal use asset. Um, if it is a personal use asset, and if it's not in a federally declared disaster area, then it's not an allowable loss at all. But if it is in a federally declared disaster area, um, you determine the loss, say it's $100,000 loss in the home, part of the home gets taken out. The way you have $100,000 loss, but then you have to subtract $100 and then 10% of your adjusted gross income. Whatever's left after that, which usually tends to not be very much at all, is your deduction. And so usually it's very rare for most folks to take a deduction from personal property losses. But Christmas tree farming tends to be a timber casualty loss, meaning that it's a business use loss. And so to calculate a loss for business use casualty losses or timber casualty losses, it's the lesser of the decrease in the fair market value of the block, meaning the damaged area, due to the event, or it's the adjusted timber basis of the block, which is what more folks tend to use. And so the adjusted basis is just your cost of a seedling plus any capitalized planting expenses. And so that can be your ground preparation, any pesticides, fertilizers that you use, any tilling efforts that you go into it with, your planting labor and planting supplies. So anything you use after it's in the ground. And again, I know sometimes the record keeping there is not, you just don't have time to go through it. We do have resources in place that can help you re-estimate what those planting expenses might have been. And so again, most folks go with the adjusted timber basis of the block, and we have ways to calculate that. And going back to several slides ago, any insurance proceeds that you receive from this should be counted against the deduction. That's also true for any salvage value. And so just to combine two terms here, if you have 10 acres in a block, meaning the damaged area, and you lost 9 acres of trees, well, you have a 90% loss in the block, but you have a 10% salvage value, meaning, the 10% of trees that are left, whatever you can get out of those, that's your salvage value. Some questions that come up with casualty losses on a regular basis is, how do I figure out my basis if I never did a basis calculation? We call that a retroactive basis determination. That makes it sound like we're launching a nuclear missile with as many big words as that is. That there's ways to do it though. It's going to take some research. You're going to have to deal with some, going back in time to see what those prices were for the seedlings at the time, for the fertilizers at the time. It's another one of those scenarios where you really need a professional tax expert on your particular case. Um, it's just you're going to save a lot of money. Spend a little bit of money to save a lot of money. Um, some people, they ask, they're like, hey, my loss deduction is going to exceed my income. And in that case, you might have a net operating loss or an NOL, which you can carry forward to future tax years. Um, if there's anything else, people want to ask, they're like, is there anything else I should know about this? And you may be able to amend a prior year's tax return and use the current year's casualty loss deduction. So for those folks who had their 2023 tax return still outstanding, you may be able to use it there. Because in 24, you might not have had a ton of income, especially if you were based off of an agritourism operation. But if you still had your 23 taxes outstanding, you might be able to switch this to there. This goes towards general property losses. This is involuntary conversion rules. And essentially, involuntary conversion is the IRS's very fancy pants way of saying we lost something and it turned into something else. And so if I had a piece of property and it got destroyed and insurance paid out on it, that's an involuntary conversion. If I had losses that turned into disaster relief money, that's an involuntary conversion. If I lost a barn and turned that same piece of property into a high tunnel, that's an involuntary conversion. There's rules on that. I attach a presentation at the end of this. And the rules are very similar to 1033E in this case. It's just not livestock related at that point. It's just like a barn or a house or a shop or something like that. Involuntary conversion rules can be used in that case. We're at the end of the presentation where I talk about resources. I run a website with Andrew Brannon at NC State. He's one of my colleagues. And I post articles all the time. I'm going to post an article about these resources on Monday. But right now we have more specific articles about the extension of the deadlines that I talked about, as well as some of the unemployment benefits that came up. Rural Tax is the ag tax professor group. It's based out of Utah State University. They post national level information. And all of these bullet points are links to articles and webinars that they have that go into greater detail about timber losses and weather-related sale of livestock, and insurance proceed rules and involuntary conversions. And it's a wealth of information. And so if you have more questions, I'm the ag tax extension professor in North Carolina. Please ask me. But if you want to go watch their resources, this is an option too. And so we want to help in any way that we can. Again, here's my email, and I'll have an article up about all this information on Monday at my website. And so I'll open the floor for questions because I'm still adding materials to that article as we write it.
Thank you. Thank you, Nicholas. Wow, excuse me. Okay, guys, you can unmute and ask any questions you might have, or you can put them in the chat.
And I'll leave the slides up in case I need to reference a slide as we go through this.
Okay. I feel certain that somebody probably has a question. It might just take them a minute to think of it.
Well, hopefully I didn't bore anybody to sleep.
So I have a question about, so our property, we had damage where we had a creek literally run through our barn, through our property, and took out fencing. And we are still to this day having to remove rock from our yard and our our barn, our field, so that we can rebuild back fencing. And we also had timber that fell on top of our fence line. So we lost all of our fencing. Is there anything that can help us with, because we did put that up last year, during 2024. Is there anything that can help us with deduction on putting that up?
Yeah, and so the rule that and I know I don't have a ton of material here, but it's these involuntary conversion rules. Um, because you would have experienced a loss. I don't know if it's been converted to insurance proceeds or if it was even insured at all. Um, but essentially you should be able to count as a loss from an involuntary conversion. Um, and you know, some of that's going to depend on how, and count yourself as a salary when you're putting that in there. When you look at, putting the fence in there, if y'all were doing it yourselves, if you'd hired a farmhand to do it. Um, but you should be able to use the involuntary conversion rules to count that as a loss. And one thing I'll add on this too, um, I know I don't have a ton of information up about the involuntary conversion rules. Um, the rural tax has a great link on this. And I don't know if I'll put that in the chat right now so y'all can have access to that a little bit more quickly. Um, I know it says Utah State on there, but that's just the university website that we run this out of because that's the the head of the group right now is a Utah State professor.
Okay.
Um, I know that is not like an immediately helpful answer. I don't know the tax line that you would put it on, but you should be able to count that off somewhere.
We also have had our fields where we have sown grass seed in for hay, and they were also destroyed.
Yeah, and so there should be because I got some questions about this through an email a little while back. Um, you should be able to get I'm assuming your cash basis first.
Yes.
Um, but you should be able to get a deduction from your loss in the value of your soil. Because as a cash basis filer, you do have value in the soil fertility. Um, and I don't have detailed rules in here on that. Um, just because North Carolina went through a very niche, it's it's common for weather incidents to occur and livestock damage or livestock losses to occur. It's common for timber to get destroyed in big storms. It's not common to have the major amount of flooding in cropland areas. Um, and so, but there are tax rules, and I'm sorry, I don't have information in here about them, but if you want to send me your email and a direct message, I can find you those rules. Um, because you should be able to recover losses from the soil fertility. I just don't have those rules handy on me at the moment.
Nicholas, if you want to, or you can just send me those. You can send me those rules, and I'll send them out.
Okay, all right.
And
What I'll
everybody,
probably do
okay,
is
go ahead.
put them in the article.
Oh
And when
yeah,
I get the article put up, I'll send it to you if y'all don't
okay.
mind waiting Monday on that.
I don't think anybody will mind to wait until Monday. I hope not. Um, before before y'all ask any more questions, just really quickly, I just totally lost my train of thought.
Is there a review
Um,
for the session?
do what?
Is there a review for the session? I know sometimes that gets asked around this time.
No. I don't remember what I was gonna ask. So you guys, maybe I'll think of it. So I'm gonna open the floor back up. So sorry.
And Lisa, I got your email written down.
I remembered. Okay. So if you do not get emails from the office, from the extension office, or you don't follow us on Facebook, let me know. That way I can make sure you get this information when it does come out. I will be sending an email with it, and I'm afraid everybody's gonna block my email address, but if you don't get those emails, let me know so I can make sure that you get them.
Could we see the website address for Nicholas?
Yes, I'll do. Let me pull this back up. So it's this right here, and I'll copy this and put it in the chat too.
Thank you.
And that covers not just Helene stuff, obviously, and not just tax rules, obviously. I know that I've got to get an article put up tonight. And this is a little bit related. I don't know if it's something that a lot of y'all followed. Kendra, you can tell me if it's come up a lot in any of the meetings you've had or the conversations you've had. The Corporate Transparency Act with the beneficial ownership information reporting rules, there was a ruling on the 18th that said that is back into effect. And you have until sometime in March to get those reports in if you hadn't already done it. If you have an LLC or an S corp, or any type of corporate entity, there's a new federal requirement that's in place. I will have an article up about that tonight, because we've been getting a ton of questions about that. I know that's not Helene related. It's not even truly a tax topic, but it's one of those things where if you don't do it, you're going to get a big fine. And it doesn't take too long to do. It still may get shot down in the courts, but right now it's up and it's active. And it looks like it's going to be full steam ahead until probably the Supreme Court does a full review on it, which may be many months, likely a year or two.
Is your email at NCSU?
Yes, yes, it did. I just caught that too.
I just wanted to make sure because I saw your web address was different from your email.
Yeah, that was a mistake on my part. I was slowly getting the quick NCSU on my muscle memory down, and it obviously is not going as quick as I'd hoped.
I apologize if you covered this already, but I assume equipment would be covered under what you were talking about, where not involuntary conversion maybe, but loss of value. Like if you flooded equipment or lost equipment, stuff like that.
Yeah, as long as it's used has a business use for it, it should be covered as an involuntary conversion. And it's not like anybody has a personal use combine that they're rolling out with, for kicks, just to roll it in the county fair or something.
Yeah.
But that should be covered under the involuntary conversion rules. And again, it may be a little hard with the record keeping to be like, well, it depreciated X amount of years. The real kicker that some people may run into is with like the bonus depreciation rules that were out, is if you had bought it in 2022 or 2023 and you depreciated the full value of it down in 2024, on the IRS's perception, it's viewed as zero. And so that's just something to be mindful of, is we had bought something and we depreciated the value all the way down using other IRS rules. Just be aware of that when you're talking to your CPA. And know, again, record keeping can be really important in that sense. I may have just opened another can of worms by saying that, but it's worth noting.
I have one question here, and that is that there's many creeks on my farm, and to get from field to field, you go across culvert areas, and they're kind of in a unique position that even with FCP through the FSA, they are not covered. So those seem to have come down on my shoulders completely in replacing and rebuilding. And where would that come into a classification on tax at least?
It's let me make sure I understand your question correctly. So you had culverts that were built up so that you could cross the creeks to access the full amount of land in your property boundaries.
Yeah, it's,
And,
meadow to meadow, creek to creek, you're crossing, and there are bridges, culvert pipes to drive the equipment over and do
Mhm.
the haying and etc. And although field damage could be classified somewhere, the access, um, losing the culvert pipes and the gravel and all that around them to rebuild so you can get across, that seems to fall into a unique category. It's not the cropland. Um, so that unique, it's expensive and it's a lot of labor. And I'm trying to figure out where to go with that particular category. And I was hoping there'd be something at least in the tax area.
So the thing that I'm thinking of right now, at least, because I see where you're coming from, is it's either a casualty loss, and I know when I talked about casualty losses, I've made examples with Christmas tree farming, um, but it's either going to be a casualty loss or an involuntary conversion, um, and the difficult part is going to be assigning a reasonable valuation to the culverts and the gravel that you had built up around that. Um, I don't know how often you had maintained it or what records you would have with respect to it. But you should be able to claim a loss um, with respect to the gravel and the culvert pipes, um, because I mean that is an involuntary conversion. What I was afraid of, and I don't know what the rules would be in this case, would be if it was just that due to the change in nature of the creek flow, if all the gravel and the pipes were still there, you didn't lose them, but the water was several feet above it now, and like it wasn't useful to you at this point. But it sounds like all the gravel and the pipes have just gone
Well,
downstream.
in most cases, I can, the pipe is locatable, but the huge trenches that need, I'll be using excavator to
Mhm.
move everything back in place and haul gravel and soil to pack in around these, and they're numerous around the
Mhm.
farm. So it falls into a unique category because it's not tillable land that has been lost. It's the access between the field to field. And so, yeah, I don't know. I haven't found a category for it.
I tend to think, and I know again this says timber casualty loss at the top of the page, but I tend to think the casualty loss is going to be where it's at because you had capitalized expenses of that area with putting the pipes in, excavating, and I don't know how long ago it was done, and so doing that retroactive basis determination is going to be tough. Um, but that you lost the benefit of the labor and the preparation, and the supplies being the pipes and the gravel as a result. Um, I don't know if those pipes are still usable or not at this point. Would be a good point.
Right.
Um,
That's so it's a mixed bag depending on where you go here, of the condition and magnitude of the project to rebuild these. And some I've taken care of, some are still yet to go. It'll take years to get everything
mhm.
in order. So um, this
It's
is it's a big expense area that seems to fall in the cracks between everything.
Yeah, and I think it to some extent falls along the same. I would suspect same rules as what Lisa was talking about. Um, but and you've got my email
Yeah.
now. Shoot
Mhm.
me follow up. Shoot me an email so that I can have like the notice like a something at the top of my inbox. And I'll look into that. But I would have to think there's some rule in place for that because you have the expenses, the labor, the prep of putting it into the ground. Um, can I ask how long ago you did that?
Well, the damage occurred from Helene, and some I repaired right away to just,
When was it installed?
oh gosh, these, some of them 20 years ago kind of stuff. A culvert pipe, you don't, uh,
Yeah, like it's a one-time thing. Like you don't.
yeah, yeah, some are concrete, some are metal, and as the concrete ones, you can kind of they're in like 6 foot sections that you can put back in place and link together, and the metal ones most times they just got destroyed.
Hmm.
uh, so we aren't talking huge diameter, 2 foot style diameter for the creek, kind of creek flows leading up to the main creeks and all of that. So, but it's a large expense and a lot of work.
Yeah, and it's probably not too easy to get hold of an excavator right now. Um, I
Yeah.
wouldn't, I wouldn't
Well,
think, or at least not cheap
yeah.
to
Well,
get hold of an
I
excavator.
I have an excavator, so
Okay.
I can do the work. It's just sizable. The magnitude with the tree losses and the field impacts and the debris that came down the creeks where there were, homes upstream, and off littered over the field and gravel in the fields and all this. This is you just pick your topic and you kind of work on that at a little bit at a time. And the it's really a big job that needs to be tended to is the access to each one of these fields. They're, like kind of like terraced meadows in the mountains here.
Hmm.
Oh, and creeks divide them.
Yeah, no, I'm familiar with there's a property that I hunt back in Georgia a good bit before I moved up here, and that's how they connected a lot. It was Northeast Georgia, and that's how they connected a lot of their fields because they would grow hay and whatnot in each field, and
Exactly.
it's not the it's not a huge amount of materials that goes into it, but when you factor in the amount of labor that and the amount of land you have to tear up to get into it, and the time and the value that it brings to do it, it's crucial that you get it done. And I'll look into it because I'm sure you're not the only one who um, has culverts that they have to repair as a result of this. I would imagine most any culvert in that part of the state has probably had some damage. Um, and so I'll
They're
look into
mostly they're mostly just gone.
Yeah. Yeah.
Culverts
For
are
the
mostly
most part, you take a creek that might have been 4 feet wide, and now it's 18 feet or something wide, and you could, if they're concrete, you can locate the pipes, but man, I'll tell you, it's going to take a lot of gravel and soil to rebuild all of that at each one. So you take one at a time and work your way through. It's just a matter of if there is a way to deduct or get even assistance on this particular category that seems to be not covered otherwise.
well, I would still think there would be a business deduction that comes out of that because know you're not doing that for your own personal enjoyment. Um, and so I would still think that a business deduction come out of it. I'm just trying to think if there's any loss that you can claim from the culvert. Um, I don't think there's any argument you can claim a business expense deduction out of that.
Well, they're easy to document with pictures, but um, yeah, well, I'll shoot you an email and then maybe I I can follow along a little better as to where to categorize it.
Yeah, because to me, you should be able to for your 24 taxes, you should be able to claim the loss. Um, and again, I'm so new that I don't know the code section off the top of my head, but I can research it.
It's
Um,
much appreciated.
yeah, and I'm doing, I want to one, I'm not looking for pity or anything, but just bear with me as I try to find answers to these questions because I do want to help. Um, but I appreciate y'all being patient with me because I know y'all
Oh,
have been through a lot, and I want to help
that's,
in any way I can. It's just going to take some time.
yeah, yeah,
But in my mind, what you should be able to accomplish is in your 24 taxes, you should be able to take out a loss for um, the gravel, the labor that went into it, the culvert pipes, whether concrete or metal, and then in 25 as you're repairing them, and some of them you probably did in 24. The expenses that you're going forth to do that, you should be able to take off of any income that you make. Um,
yeah. And can these losses be spread over future too? Is it all got to be in the year? It is, I am a cash basis, but when you've got expenses that are going to be lumped together 2025 calendar year here, um, can those expenses, those losses be spread over a number of years, or is this something that you need to fully take in that 1 year?
yeah, so and I'll clarify this when I send you an email. It's also for those of you who aren't um, part of this back and forth. It'll be in the article as well, just to confirm. You should be able to get a net operating loss if you have losses that exceed your income and carry that year over year. Now, there's some pretty particular rules that go along with NOLs, but it sounds like you're in a situation where that should be qualifying. And when I post the article on these rules, because I'm more or less going to post it like a FAQ, I experienced. I probably won't talk about. Oh, I probably should talk about covered losses. I'll take anybody's names out of this and make it general, but um, and so it'll answer more specialized questions like that.
Yeah.
But and obviously, if you have more questions from the article, still shoot me an email. But you should be able to carry over that NOL for years to come.
I think that NOL topic will be of interest to a lot of folks here because the losses have come in a big lump.
Mhm.
And, if you aren't making a whole bunch and you can't carry it forward, it's a tough situation. But if you can spread it over a number of years, it isn't such a big impact.
Yeah, because this is something, it's the recovery is going to take a while for most
Yeah,
folks.
right.
And any
Years.
income you make is, you're going to need to keep as much of it as you can.
Well, thank you, Nicholas.
No, I really appreciate it. Thank you all so much for coming because these questions are so crucial to me being able to do a better job at my own job.
Um, I was trying to think of the unique situations I've seen, and I don't want to keep anybody too much longer, but I know of a few people that lost their fuel tanks. So they had their tanks that they had filled with their off-road diesel for their equipment, and like that week even, and then they were completely washed away. So that is also something that people are facing as well.
I don't think that it matters with respect to the type here, but I'm assuming most of those are above ground tanks.
Yeah, they're just above ground tanks that they use
Okay.
to fuel their equipment. So they had off-road diesel in them. Most of the ones anyway.
Okay. I know sometimes the rules can make distinctions between subsurface and above ground tanks. Um, I doubt that the IRS is going to have a distinction between the two, but I know the EPA has, and I've been doing a lot of EPA research lately, can sometimes have a cow between the two different types. But I also recognize too, having a below ground tank in the mountains is probably not as likely.
Well, my heating oil tank is below ground. So, but anyway, the ones that washed away were above ground, and there were instances where they had just been filled. So that is a loss, and I don't know how you would file that, or if you could, but if you can, I'm sure that that's some information people would like to know.
Okay. Now I'm keeping by the way, I am keeping a list of I don't know if it's going to show up on.
We can see
There's
you
a list
writing
in my
down.
hands, yes,
Yeah,
of
we can
questions that
see
I've been
you.
writing down.
I can see your arm moving. I know you're writing it down. Anybody else have anything? And he did share his email. If you lose his email or you didn't write it down, I can send it to you. I will tell you, and he said it too, but I will speak for him here. Be patient with him. It might take him a while to email you back. Just because he is trying to serve the whole state right now, and there are so many counties that have been affected. So be patient with him, but he does want to help. So, but yeah, any last thoughts or questions?
I
I
do
don't want
have
to cut
one
anybody.
more question. It's about the disaster hit last year in 2024, but we are still repairing things now. How do we claim that on the 2024? Like, how do we go about even in 26 filing that against our taxes?
Are you referring to like the expenses that you are paying out? Um,
Yes.
okay, yeah, so those are still related to the disaster that occurred. And it's in some ways, and this goes to the point, I can't see your name, but it says MK iPhone, that we were talking about with respect to carrying over net operating losses. Um, as long as it's a business thing that you're, and it's not a personal expense that you're trying to recover, and it relates to your business, which it would have to if it's not related to your personal use. Um, you should still be able to claim that because it's a business expense that you're carrying out. It doesn't matter that it's occurring a couple months after, effectively a couple months after a lien, but in reality, in a new tax year, because it's a necessary business expense that you're having to undertake. Now, the losses that you took from your soil fertility and from culverts and from above ground tanks and fencing, you can claim those losses in 24, but the expenses that you're having to carry out, those are also going to be recoverable, should be, regardless of the year that you paid them for, because you're still paying the expenses out. The expenses, to answer your question more thoroughly, would be taken out in 2025 taxes, if they were paid out in 25 though.
Okay. Thank you.
And to give some optimism, it would be more ideal to have some of your expenses in 2025, um, because if for whatever reason you can't carry your NOL over, um, well, those expenses that you're undertaking in 2025 will be able to reduce your 25 income. Your 24 income is probably not that high due to the storm, um, but your 25 income will hopefully be higher as people try to come in and support the community any way that they can. Um, but your 24 income, you're probably not too worried about it being too high.
I had one more thing, and this is just a yes or no question, so I don't want to overcomplicate it. But
There's
to
no
claim
yes or no
something,
questions with lawyers.
well, okay, well, you can, so the extension answer is always it depends. So you're an extension lawyer, so you really get to like use that and like riff off of it. But to claim something as a business expense for in regards to farming, I'm assuming you have to have a Schedule F filed. Would that be correct, or do you have to have like a legal business entity or something?
It really, really depends.
Okay. Hey, that's a
Yeah,
good answer. I will take the
yeah.
extension answer.
I will put so I'll and again that's more me being new to the position than me being in extension or in an attorney. I'll put that specific question because that's probably like question number one for a lot of folks in the article. Is that a good compromise? Because I don't want to give you wrong info tonight. Um,
Yeah,
you,
no, you're fine. You're fine. I think I can speak for everyone, not only on this Zoom, but everybody. We'd rather get the correct information than something you just came up with because you're on the spot. So you're fine.
And to be clear, like I do plan on getting that article out on Monday. So like it's not like I'm gonna like be like in November of this year, be like, hey, remember that question you asked me about your
No.
2024 taxes? Like
Yeah, no,
maybe
it's
this was
okay.
helpful now.
You're good. You're good. Okay. Well, Nicholas, if you have any last thoughts, I'll let you
Well,
share
email
those.
inbox is always open. I do have an office number listed on my website page. I am rarely in my office because I'm teaching 3 classes right now, and I'm also traveling a good bit trying to get extension work done when there's not oodles of snow on the ground everywhere. And so if you don't catch me on my office phone, don't be surprised. An email is always going to be the fastest way to reach me. And so I want to help. I want to do whatever I can. And I'm trying to get this content out as quickly as I can. So, I appreciate everybody coming tonight, and the questions really have helped me. And so hopefully I can use those questions to help everybody else, including y'all. So thank y'all.
Well, thank you. We really appreciate it. We do wish that you could have joined us in person, but I just don't know that that was feasible tonight.
No,
But
I agree.
we'll get you up here sometime for something. But
I'll be happy to join y'all.
okay, well, we appreciate it.